Hi friends, how are you all? So, in this lecture we will be dealing with a continuation of last portion, that is balance of payments. Now I am telling you this is a continuation of the portion of foreign exchange rate. Let me tell you why first. See, consider the accounting concept. A business entity, let's take some business person, he undertakes many transactions with many people, customers, suppliers, right, creditors, debtors, many other things, or the government and many other things. And what does he do? Or how does he transfer? How does he trade? He trades in the concepts of money and goods, right? Money and goods is through which he trades. Now, what does he do? He records the transactions systematically, right? He records all those transactions systematically. And what does he do? Any business enterprise, whether it be sole proprietorship, partnership, joint stock company, cooperative society, everybody has to prepare two statements, like the profit and loss. And then importantly, they will have to portray their balance sheet. What does the balance sheet show? Where do I stand with respect to my transactions? Where do I stand as a result of all the transactions that I have undertaken with outer people, or anybody like suppliers, customers, anybody? Because of their transactions, what is my current financial position? Where do I stand? What do I own? What do I owe? Such things. And what is my net effect? Whether I have made a profit or I have incurred a loss. So all these things are portrayed in the statement called balance sheet. Balance sheet is not an account. Can you tell me? An account is where you write all the debit and credit and you balance it. And you tell to balance carry down or to trading account or to profit and loss account. But balance sheet is not an account. It is basically a statement that shows the status or the financial status of the business entity concerned. Right. Now, how do we relate this concept to this portion or the balance of payment? There is one word common. Balance. There is one thing common. So, can we relate the balance sheet and the balance of payment? Tell me, can we relate balance sheet and balance of payment? Yes, of course we can. Do you know why? Balance sheet is with respect to the daily financial transactions of any enterprise, whatever they may be. However, balance of payments is related to the foreign exchange rate. Instead of daily transactions, we are substituting foreign exchange transactions. That's all. There is nothing changed. So, how do we define the balance of payments? It is a systematic record. Systematic record of all foreign exchange transactions. Systematic record of all foreign exchange transactions or transactions with the rest of the world. Anyway, any foreign exchange transactions will be done with the rest of the world, no change. Say I am in India, I am paying to a seller in India. Do I pay in dollars? Am I so mad that I will pay for any purchase in my own country in foreign currency? No, I will never pay. Whatever I do in my country, I will pay in my own currency. Okay. If I will pay in foreign currency only if I am doing something outside India, right? If I am in India. If you are in the United States or if you are in India, you will be paying all your domestic transactions. You will be doing all your domestic transactions in your domestic currency. You will be resorting to foreign currency only if you will have to transact with the rest of the world. So, all foreign exchange transactions will be carried out with the rest of the world. systematic record of all foreign transactions by citizens, business or government. Anybody can transfer. If you are going outside India for a tour, you will have to pay in the foreign currency. You are a citizen. If any business is buying imports, supplying, then it will have to be done in foreign exchange. If the government is engaging in any foreign exchange transactions or transactions with any government outside India or foreign government, they will have to do foreign exchange transaction by any citizen, business or government during given period. This is also important. So this is what the four features. It is a systematic record. It is a systematic record of all foreign exchange transactions. Of a systematic record of what? Foreign exchange transaction. Who is doing these foreign exchange transactions? It can be citizens, government or business enterprises of any country. And when is this done? During any given period, usually 1 year. So what are the two parts? Or before I go into parts, let me tell you another concept, that is balance of trade, BOT. See, you know what is trade. Trade contains two components, import, export. Right, import and export. Any transactions done with import and export of goods or services will come in balance of trade. Any transaction relating to import of export or goods or services will come in balance of trade. Any transaction relating to import and export of goods and services will come in balance of trade. Okay, so generally the balance of BOT will be export minus import. This will be the balance of trade. But do you think this is the balance of payments? Does the country engage only in import and export of goods? Definitely not. There are many other types of transactions. Let me give you a few examples. Say your relative is staying outside and they are sending periodically money to your family in foreign currency. This is foreign, not donation, but it is just transfer to relatives. Right. That also is coming in balance of payment because it is done by citizens, because it is coming to our citizens, therefore it is coming citizen. So that is also engaged in balance of payments. But it will not be there in balance of trade because you are not selling anything in order to earn that money. Your relatives are just giving you money, right? Then there may be other capital transactions. Say any business enterprise in our country is buying some asset in the foreign nation. That investment will also come in balance of payment, but it will never come in balance of trade. Investments will never come in balance of trade. Okay, so we can tell in short that balance of trade is a part of balance of payment. This is with respect to balance of trade and balance of payment. Now, how do we calculate balance of trade? It is not just exports minus import. Amount of exports minus amount of import. Amount of export does not mean number of goods. It means the value of the goods. That is value of export minus value of import. Value of export minus value of import. What is this value? Amount into quantity. Amount into quantity is relating to value. The amount of goods exported into their price, means the number of goods exported into their price will be export. The number of goods purchased into their price will be import. So this is the computation of balance of trade. Now, what are the features of balance of payments? We know all the features. So it is a systematic record and it is comprehensive comprehensive because it includes everything, right? Since it includes everything, it does not leave out anything, it is comprehensive. Then it uses double entry system. We always use double entry system, you need not tell that. And there is a fixed period of time and it's related to foreign exchange, everything is there. Now, what are the three forms of balance of trade as well as balance of payment? You know that. But before I tell you this, let me tell you one more thing. Inflows versus outflows. Okay. What is inflow of foreign exchange and what is outflow of foreign exchange? We have already studied this. In the last chapter, remember? We studied the demand for foreign exchange and supply of foreign exchange. So we are just changing the terminologies here. Simple. Short job, nothing. Right? Okay. We are just substituting demand for outflow and supply for inflow. That's all we are doing. We are not doing anything else. Whatever causes demand is an outflow. Whatever causes supply is an inflow. Simple, basic concept. Now, with this we are going to look at how, let's say, outflow less than inflow. Outflow is equal to inflow. Outflow greater than inflow. That is, outflow of foreign exchange is less than inflow of foreign exchange. Then it will be called surplus in foreign exchange, right? Okay, that is, whenever we are getting more and we are giving less, then it is called as favorable or surplus. When it is balanced because no change, this is unfavorable or deficit. We studied the same thing. We can relate it to balance of trade basically. Okay. Whenever import of goods is greater than export of goods or export of goods is greater than import of goods. Whenever this outflow will be for import, inflow will be for export. Outflow less than inflow means, you mean import is less than outflow, then it will be favorable. We are exporting more. Outflow is equal to import, or inflow means import is equal to outflow. Import is equal to exports. Balance. Outflow greater than inflow. We are purchasing more and we are selling less. Outflow of foreign exchange is greater than inflow means it is unfavorable or deficit balance of trade. So this is about favorable and unfavorable balance of trade. Now, what are the components of BOP, balance of payments? First of all, visible trade. Visible trade is goods. Only goods, because our service is visible. I am teaching you, is the service visible? No, it is not visible. My person, I am visible, but the service that is given here is not visible. It is actually service, invisible item. This is another component of balance of payment, invisible. Services. Here in these two, what happens? Somebody is supplying the service or good and other one is paying. It is dual, bilateral transactions. Somebody has to give service and somebody has to give payment. Somebody has to give goods, others have to give payment. But when this is not done, unilateral transfer. We have studied in transfer payments, right? In national income accounting, we studied about transfer payments. That is, no further services are rendered in return, but the payment is made. Such things are called transfer payments. Here also it is the same. Unilateral transfers are taking place between two countries and not within the country. Only that much. And naturally they will be taking in foreign exchange. But No service is rendered in return. Somebody is receiving payment or somebody is giving payment. That's all. Nothing is done by the other party. Let's take our example. If your relative is staying abroad and they are sending money periodically for the family, your family is not giving them any service. They are rendering from their own salary. Now, if you are telling that when a son is sending money to his parents, he is sending because he is earning money. He is not sending it as a payment to the parents for taking care of him in his childhood. Don't tell me that, okay? Your parents will have taken care of him in the previous age and so he is paying money. Don't tell me that. Okay. This is just unilateral payment. Suppose our government is giving a donation to some foreign government or some help, not in aid of loan, then it is actually a unilateral payment. Okay. Then the next type is capital transfer. Capital transfers are all things related to assets and liabilities. They are not related to income and expenditure, they are related to assets and liabilities. Purchasing of asset, granting of loan, repayment of loan, taking loan, everything will come there. Okay, selling of asset. So this is about the components of balance of payment. Now, how do we organize the balance of payment? How do we organize the balance of payment? There are two parts of the balance of payment. That is current account and capital account. You know what is current account and you know what is capital account from basic accountancy, I know. Current accounts records all those things they are done in day-to-day basis. Okay, day-to-day basis means it is not that only transactions that happen daily throughout the year should be recorded here. No. This means the transactions that do not have any bearing on us in a future period. They do not have any bearing on us in the future period. Let me tell you, you are purchasing a good and you have made payment for that. It only impacts the current financial position. It does not impact any future financial position. However, if you are taking a loan from outside, then you will have to pay interest and principal in the future period. It has bearing in the future period. You will be showing a liability even in the future period till the loan is fully paid off. Such things are called capital transfers. So, it includes visible trade, invisible trade, and unilateral transfers. All three will come in current account. Here, capital transactions will come in capital account. So basically nothing over to think about it. All transactions which are in the nature of income or revenue or expenditure will come in current account. Okay. All transactions which are in the nature of capital, they will come in capital account. We have studied this in another form in our foreign exchange rate lesson. Remember, we studied that any transaction that does not cause reduction in assets or increase in liability, or in the other hand, it does not cause any change in assets or liabilities, they will be treated as current account transactions. Capital account transactions, they can either lead to increase in assets or decrease in assets, or they can lead to increase in liability or decrease in liability. They will have any one of this effect, not more than one, any one of this effect, then they will be called capital account. Okay, so this is about current account and capital account. Now, before we go into the next part, we know what is invisible trade. What all trades are generally done in invisible trade? It can be shipping and ferrying. It can include shipping by air or water. You can not ship by road or rail, generally. Okay, so we will consider only air and water, and there will be insurance. See, you are a producer in India and you are supplying goods. You are selling goods to say Denmark. You will be ferrying your goods to Denmark through a company or shipping agent. Some ship generally. Let's take the ship itself. Don't take air. When you are trading the ship, suppose the shipping company is a Denmark-based company. It is not an Indian company. It is a Denmark-based company. And therefore, the supply, the service of shipping for you is an export, an import, because you are taking the service to have your goods sold. Now, if you are insuring those goods against law, cargo insurance, hull insurance, ship insurance, marine insurance, whatever you take, suppose you are taking it from a company of Denmark, then also that service will be an import for you and export for that company in Denmark, because the service is not rendered to a domestic resident. Okay, such services will be in case of shipping. Suppose there is a travel or tour you have taken on, somebody is undertaking a tour abroad. Whatever purchase and sales they do in the foreign country, that will be included in visible trade. But this traveling job is done, right? That job will be done in this. Okay. So these are the main components of invisible trade. Now, let us take the structure of balance of payments. Okay, let us now take the structure of balance of payments. Before that, let me give you a short introduction of capital account elements. Capital elements can include loans and repayment, or loan repayment done by anybody, or the foreigners. Loan, giving loan, taking loan, repaying loan, retrieving loan. Okay, recurring of loan, this will be taken in capital account. Now, other transactions are official transactions. Anything that is done by the official monetary authority of the government. In nature of official transactions, that might be to stabilize the balance of payments and many other things. Next, we will discuss the related to the balances. You know what is balances? Surplus, deficit, set, and balanced. You know what the three? Here, outflow means less than inflow. We are getting more inflows in our foreign exchange and lesser outflows are going on. Here, outflow is equal to inflow. I have already told you what are outflows and inflows. Here, outflow greater than inflow. Here deficit is less greater than inflow. Here it is balance. Balance of payments is these are the three types of balances that can occur in the BOP of any country. Now, what happens in these three situations? See, whenever there is a surplus of BOP, the government foreign exchange reserve, the monetary authority will be keeping some foreign exchange reserves. These reserves will go up because inflow is high and outflow is less. Here there will be no change will take. But here the reserves here there will be no change. Here the reserves have to be brought down. Reserves will come down because more is going out on less is coming inside. So this is the reserve transactions. Mainly the reserves will be used to stabilize the foreign exchange rate. Because of any situation or any transaction, the foreign exchange rate or the value of our currency should not go in any direction. Too much positive or too much negative is bad. So now let us discuss the structure of BOP. First is the goods and services account. See, here there will be a debit and here there will be credit. What do you do? What do you do in accountancy if you have studied accounts? Okay. What we do generally is we put all expenses in debit, income in credit, right? Generally this is what we do in accountancy. But don't tell me this answer to economic balance of payments. Don't ever tell me this answer in balance of payments accounting. We record here outflow and here we record inflow of foreign exchange into our country. Never tell me expense or income, this is just outflow and inflow. Okay, so first we take goods and services account. What are means goods and services account? What will be the outflow? Purchase of goods or import of goods. Similarly, import of services. Right. Here it will include all exports, because only exports of goods and services are inflow of foreign exchange into our country. Imports of goods and services are outflow of foreign exchange from our country. So this is the first account of goods and services account. Then we have unilateral transfers. Unilateral transfers account. Here what happens? Any unilateral transfer made from our country to outside will be here, into out. Transfers to outside will be included here, and transfers from outside to our country will be included in credit side. Okay. Then what is the third? Then we have long-term private capital account. There are many accounts. Long means, let's take not private capital, long-term capital account. Long-term capital, what happens? What causes outflow of foreign exchange? Increase in asset or decrease in liability. Why? Increase in asset means, let's say we are purchasing some asset in the foreign nation. For that we will be paying money in foreign exchange. That is an outflow. If we are repaying any loan we have taken from foreign country, that also will be an outflow. So here it will be included in increase in asset and decrease in liability. And also, for us it is an increasing asset and decreasing liability. What will be for the foreign government? If their foreign assets, for them the foreigner, any asset in our country is a foreign asset. Any asset in decrease in asset and increase in liability in our country held by foreigners will be taken in debit side. And the direct opposite of this, if our assets are going up or our liabilities are going up, means our assets are going down and our liabilities are going up, we will record it in credit. If their asset, if we are taking Denmark and India, we will not consider any transaction between Denmark and USA or Denmark and Germany or Denmark and UK. We will only consider transaction between Denmark and India. Okay. So any decrease in asset or increase in liability of our citizens or government, those are foreign assets or foreign liabilities will be included in credit. And similarly, any increase in our country assets held by foreigners or any decrease in our country liabilities held by foreigners will be treated as credit side or inflow of foreign exchange. Now, in short, this is about long term. Okay. In short term, we are dividing it into two. Short term, private and official. The same thing. In private short term, if we are in same thing only, but it is divided into two parts, private and official. I will tell you why later. So this is the structure basically. Anything that leads to outflow of foreign exchange will be included in debit, and anything that leads to inflow of foreign exchange will be included in credit side of the balance of payments. Okay, there are two types of transactions that can be done. There's the autonomous. First is autonomous types. Okay, what is autonomous transaction? That happens whatever we are not doing it. We are doing purchase or sale or capital transaction. Everything will be coming in autonomous transactions. It does not depend on the position of the foreign exchange position of the country or the position of the balance of payments. It does not depend on the position of the balance of payment, whether it be surplus or whether it be deficit or whether it is balance. These transactions will definitely happen. But there are accommodating transactions. What are accommodative transactions? These are done in order to stabilize the balance of payments. Okay, I told you if there is surplus, the country's central bank will purchase foreign exchange so that the country's foreign government will make some investment or something in foreign exchange, or it will withdraw some foreign exchange from the economy so that the balance of payment is brought back to equality. But if there is deficit of balance of payments, then the government will have to take loan or something from the foreign countries in order to stabilize our balance of payment. Such transactions are called accommodative transactions. The main category of accommodative transactions are reserve transactions. Let's take this is the RBI in India, Reserve Bank of India. Reserve Bank will have many reserves, forex reserves. Okay, reserves. What does the Reserve Bank of do with these foreign exchange reserves? If ever there is surplus in the foreign exchange transaction or balance of payments of the country, they will withdraw or from economy or increase the reserves, accumulate reserves. However, if there is deficit in the balance of payment, the Reserve Bank will draw down its reserve. It will start releasing foreign exchange into the economy so that the balance of payment is balanced. Okay, this aspect is considered in the operational sense of BOP. This is the operational sense. It states that due to autonomous transactions that happen, that generally take place, some deficit or surplus is bound to occur in most cases. And accommodating transactions are done in order to adjust the effect of the autonomous transactions. But if you are considering balance of payment in accounting sense, then it will be balanced. Okay, it should always balance. But that is accounting sense. What will happen is, let's take outflow and inflow. Outflow and inflow of foreign exchange, debit and credit side. Outflow of foreign exchange, let's say, is rupees 100,000 crores. And inflow is 80,000 crores. And what will happen? The government will undertake any reserve or accommodating transaction of 20,000 crores. And as per accounting sense, the both things are balanced. However, in the operational sense, we are looking into the items in the account. This is okay, but this thing is done in order to stabilize the balance of payment, and it is an accommodating transaction. That is why we are separating short-term private capital and short-term official capital transaction, because any sort of accommodating transaction will be short-term official transactions. Any short-term official transaction will include mostly reserve transactions. That is why we are separating only in the case of short-term capital transactions. So this is all with respect to this lesson. Okay, first we saw what is balance of payment. balance of trade, what are the components of balance of payment, what are the parts of balance of payment, what are the types of transaction, types of account, what and types of autonomous accommodating transaction, operational sense, accounting sense. So this is all with this chapter in macroeconomics, and before I leave, let me tell you that this is the end of our theoretical part or basic part in macroeconomics for class 12. I hope you found my videos useful, and please subscribe to my channel, and if you have any doubt you can comment in my channel videos. So we will be meeting again, and so till then stay safe. Thank you.